Hey everyone, welcome back to Finance Friday. It is another special edition of Money Girl where I answer your burning money questions. Today's question is from Maya. She says, "Hi Laura, I love the podcast. My husband and I are in our mid-30s with a dual household income of $175,000 and 2 kids under the age of 3, which means a considerable daycare expense. Our mortgage balance is $120,000 at 7% interest, but we have no auto loans or credit card debt. We have emergency money in high-yield savings for 3 to 6 months. I max out a Roth IRA annually and contribute enough to get my 401k match at work. My husband has a state-funded pension plan. If we have extra money in our budget, should we invest it for midterm goals and retirement or pay down our 7% mortgage, which I've heard some define as a high-rate debt?" Well, thank you for your awesome question, Maya, and congratulations to you and your husband for doing such a great job with your finances. I mean, you're only in your mid-30s and you are well ahead of many other people your same age. So again, a big virtual high five to you for doing that. This podcast will review how to prioritize any extra money you're fortunate enough to receive. Whether you get a raise or it's a cash gift or inheritance or you win the lottery or maybe you just cut expenses out of your budget, that is a terrific opportunity to strengthen your financial security. Again, thanks for joining me this week. I'm Laura Adams, an author, personal finance spokesperson, money speaker, founder of the Money Stack newsletter, and host of the Money Girl podcast with 43 million downloads. If you're not already subscribed, you want to do that so you never miss an episode. We're now doing 2 shows that come out on Wednesdays and Fridays. Also, if you've got a question you'd like me to cover on a Finance Friday Q&A show, I'd love to hear it. I want you to leave it on our voicemail line by calling 302-364-0308. And of course, you can also send me an email using my contact page at lauradadams.com. And while you're there, go ahead and sign up for The Money Stack. That's my newsletter that goes out 3 to 4 times a month. It's filled with all kinds of financial tips, news, advice, my personal recommendations, and also invitations to live educational events. So I would love to see you on the list. All right, let's talk about whether it's better to pay down a mortgage or invest when you have extra money. This is a common question, Maya. And while I am a huge proponent of keeping low debt levels, there are times when investing is better for building wealth faster. So before you make any significant decisions, I would love for you to just take a step back and think about your finances in a holistic view. Consider what you really want to accomplish with your money. Otherwise, you're just not likely to make decisions that move you toward your financial goals. For instance, you may want to throw an extravagant wedding. Maybe you want to put your kids through college, start a business, or even purchase additional life insurance. Only you know the answers. So really think about what's my current financial situation, what are my goals, and how am I going to bridge that gap from where I am now to reaching my goals. And we're going to go through 9 tips for using your extra cash wisely. So number 1 is to boost your emergency savings. When you're fortunate enough to have extra money, you want to cover the basics with a healthy emergency fund. How much you need depends on your income, expenses, debt payments, and goals. However, a good rule of thumb is to keep at least 3 to 6 months of living expenses on hand. And that's what Maya says she has. So she's in great shape. Maya, maybe you want to review that and just make sure that is still enough for you based on, all of your family's goals. If accumulating that much seems out of reach, just start with a small goal like saving $500, then $1,000 until you have at least 1 month's worth of security and build from there. Even a small cash reserve is better than nothing. Saving, not investing, is the right move for reaching short-term goals like maintaining emergency funds, taking a vacation, or buying a car in the next few years. While you won't earn as much compared to investing, you can rest easy knowing your cash will be there plus interest when needed. Creating a healthy cash cushion should be your top financial priority if you don't already have one. Tip number 2, when you have extra money, is to review your insurance needs. So this is another essential way to prepare for the unexpected and prevent risks. You want to have various insurance policies like health, life, disability, auto, homeowners, or renters policies. Being uninsured or underinsured means that a disaster or a theft or accident could wipe out everything you've worked hard for and jeopardize your financial future. So I recommend that Maya review her insurance and fill any coverage gaps with that extra cash before prepaying a mortgage or investing. She mentioned having small children, which means she and her husband should have life insurance policies to protect their futures. Even if you get life and disability coverage through work, I recommend that you review it. It may not be enough to protect your family. Plus, remember that if you leave your job for any reason, those policies typically end immediately or by the end of the same month. So, having additional policies on your life or for disability can be a good idea depending on, what you're already getting at work. Tip number 3. Pay off dangerous debts. So after you use any extra money to prepare for the unexpected with emergency money and insurance, pay attention to any dangerous, expensive debts you may have. Now, Maya said her mortgage is her only debt, which is fantastic. So she does not have any dangerous debts. But if you have dangerous debts or you have more debt than Maya, I recommend listing out your outstanding balances and their interest rates. Then you want to sort that list from the highest to lowest interest rate. And in general, you want to tackle them in that order. But if you've got dangerous debts, and these are things like overdue child support or overdue taxes that you haven't paid, you want to make those your top financial priority because they can really devastate your finances if you don't get them caught up. So let's say you've got a credit card balance at 24% APR, a car loan at 10% APR, and a mortgage at 7%. You want to pay down the credit card first because it's costing you the most interest on a percentage basis. Paying off debt gives you a straightforward, guaranteed return. For instance, if you're carrying credit card debt charging you 24%, paying it off is an immediate 24% return on your money on an after-tax basis. You would be hard-pressed to find an investment yielding that much. So that's why paying off high-rate debt is so important. However, there's less benefit for prepaying lower-rate tax-deductible debt, such as a 6 or 7% mortgage. Maya mentioned hearing that debts at that rate are considered high interest. Well, the fact is, if you claim the mortgage interest tax deduction on your taxes, it makes a home loan cost less on an after-tax basis, such as around 1% less. So Maya, if you're claiming that deduction, it's likely netting you down to 6% interest or even less. So prepaying lower rate tax-deductible debts like mortgages, home equity loans, and even student loans is typically not wise because you could get higher returns by investing your money instead. So, the trick to knowing if you should prepay debt or invest is carefully considering which option will likely give you the highest return over the long run. If you send extra money to relatively low-rate debt, instead of investing for compounded returns, it could prevent you from building as much wealth. All right, tip 4, maximize a workplace retirement account. Maya mentioned investing enough in her workplace retirement account to get her employer matching. I want to recommend that she put her retirement ahead of her creditors and increase her contributions to at least 10 to 15% of her gross income. If you slowly increase your retirement contributions yearly, you will max out the account before you know it. And if you do that consistently for decades, you will likely have a multi-million-dollar account to spend in retirement. For 2024, you can contribute up to $23,000 or $30,500 if you're over 50. And that's in addition to any matching funds your employer may contribute on your behalf. Tip number 5, maximize a self-employed retirement account. If you're self-employed like me, you also have excellent retirement options. So don't forget, you could use a simplified employee pension plan known as a SEP IRA. That's the account I use. It allows you to make tax-deductible contributions up to 20% of your net self-employment income. For 2024, you can contribute up to $69,000 to a SEP IRA. However, you can only contribute as much to a SEP IRA as you earn. I love my SEP IRA because it's easy to maintain with no annual paperwork. It's a really excellent option for business owners with or without employees. You can contribute any amount up to the limit, up to your tax filing deadline for the prior year. Another great option when you have no full-time employees, except a spouse or a business partner, is a solo 401k. However, you can only fund it through payroll deductions. So that means paying yourself a regular salary and calculating and submitting quarterly payroll taxes to the IRS. Tip number 6, maximize a Roth IRA. Maya mentioned maxing out a Roth IRA annually, which is excellent. However, if her workplace retirement plan offers a Roth option, I suggest that she max that out first because it has a much higher annual contribution limit. As I mentioned, at Maya's age, she can put in up to $23,000 in her workplace retirement plan for 2024. Her IRA contribution limit is just $7,000. So Maya, again, I'm going to recommend that you really go for maxing out the workplace and use the Roth option if possible. And then if you can max that out and you still have more, you can max out the Roth IRA because you can do both. You can max out a Roth IRA and another retirement plan like a 401k or even a self-employed retirement plan in the same year. So again, I'm going to challenge you, use that Roth at work first and then a Roth IRA annually. That's going to boost the tax-free income that you can enjoy in retirement. Tip number 7, maximize a health savings account or HSA. Maya didn't mention having one, but this is another great way to invest extra cash if you qualify. An HSA is one of my favorite accounts because it offers the most tax benefits, but you have to be enrolled in an HSA eligible high deductible health plan to qualify. And you can get that coverage through a group health plan at work or buy it on your own as an individual. For 2024, you can contribute up to $4,150 to an HSA if you've got qualifying insurance for just yourself, or up to $8,300 when you have a family insurance plan. Plus, if you're over 55, you can contribute an additional $1,000 to an HSA. Tip number 8, fund a 529 college savings plan. Since Maya has young children, if she wants to pay their education expenses, I recommend using a 529 plan to start saving. And she may already be doing that, but she didn't mention it in her email. In addition to paying for college tuition, room and board, books, and computer equipment, recent 529 changes allow you to spend funds on younger children as well. You can use up to $10,000 per year for expenses for students in public or private kindergarten through high school. While 529 contributions are not tax deductible, your account's earnings and the investment growth are never taxed if you use the funds for qualified expenses. And there are no restrictions on annual income to participate in a 529 plan. And our last tip for what to do when you've got extra income is to invest in a brokerage account. So once you've got enough emergency money and the right insurance policies, and you've exhausted all the tax advantage ways to invest your extra money, then it's time to consider investing through a taxable brokerage account. Your tax rate depends on whether you owe short or long-term capital gains and your tax bracket. And if you want to learn more, you can listen to Money Girl episode 834 called "What Tax Will I Owe on My Investments?" And Maya, if you're still conflicted about investing extra money or using it to pay down a home loan, You can always do both. I am recommending that you really lean more toward the investing side because a mortgage has such a low after-tax interest rate. You're going to get a lot more potential growth on that money if you invest it. But you can always do both. You could invest half the amount of your extra money and then use half to pay down your mortgage. So I hope that has been helpful for you and everyone listening when you've got a little or maybe a lot of extra money. That's all for now. Remember to visit lauradadams.com to send in your email or subscribe to the Money Stack newsletter. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our amazing team. The show is audio engineered by Steve Rickyberg. Our director of podcast is Brandon Gachus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. And our marketing and publicity associate is Davina Tomlin.